Good evening and welcome to the 2015 Life Changes Be Ready webinar series. I'm your host, Jim Thompson from LifeChangesBeReady.com. It's good to be back after a short break, and our mission here at Life Changes Be Ready is to awaken individuals, families, and communities to the need for preparedness through education and training, while also providing access to premium products that aid in the pursuit of a lifestyle of self-reliance. Tonight's expert is Dr. Kirk Elliott, aka America's Financial Doctor. We refer to Dr. Elliott as our Life Changes Be Ready in-house financial expert. Dr. Elliott is someone who understands the prepper mindset when it comes to finances. And with everything that is happening worldwide with regards to the financial markets, and with September just around the corner, we knew it was very important that we hear from Dr. Elliott tonight. If you're not familiar with Dr. Elliott, he is an author, economist, as well as a political, economic, and social commentator and documentary producer. As a wealth manager for the McIlvaney Financial Group, Dr. Elliott directs assets for over 1,800 clients in America and other parts of the world. Dr. Elliott serves on the boards for Dr. James Dobson, Patrick Henry College Foundation, Students for Life, and Council for National Policy Incorporated. The format tonight is going to be a little different than some of our previous webinars. Our webinar is completely live, and Dr. Elliott is going to share, in a sense, breaking financial news with you and how it impacts you and what you can do about it to thrive in the midst of chaos. Afterwards, Dr. Elliott will dive right into the questions that you all have submitted. So feel free to submit your questions in the chat by hitting the button that, below in the webinar screen. You'll see a button right at the bottom that says Ask a Question. Click that, type your question in, and it'll appear with us, and we'll ask Dr. Elliott your question. Dr. Elliott is now with us. Kirk, are you with us?
I am, Jim. Thank you very much.
Thanks for being here. We always enjoy having you on, and your sessions are always some of our best attended, so we've got a big crowd tonight. In fact, I noticed that there was a database error connection, which means that the server had a little difficulty getting started. So we should be good to go. Everything should be live. And I'm going to turn it over to you. If you have any questions or need me for any reason, just say so, and I'll come back in. But as it stands now, Kirk, you've got the floor.
Well, great. Thank you very much. I love to hear that there's a database error because there's too many people other than there's a database error because I'm the only one on the line. So this is some good stuff. Well, you know, as Jim was talking, this isn't going to be the normal format that he usually does. It's because everything that's been happening the last few days has been so timely. Actually, over the last couple of weeks, I just wanted to get on and talk to you all because we really need to protect ourselves from what's coming. As a PhD economist, I look at trends. I look at cycles. And there are some pretty intense cycles happening, and we're going to go over all of them tonight that I'm looking at, whether they're financial or economic or interest rate cycles, and even some spiritual cycles that go all the way back to Hebrew calendars. I mean, basically since creation. I mean, and these are all culminating this fall. This is why it's so important that we get this information out today. And so, but I'm going to start with some of the financial cycles because with what we saw in the markets just today, I mean, looking at some numbers, energy and materials are down 55% year to date. China devalued the yuan. So why do they have to devalue the yuan? So as an economist, you never look at something just at face value and accept it. You should look at something, it's like, okay, why did they have to do what they did? Because once you understand the why, you can actually allocate properly, you can hedge yourself properly, you can do things that actually make sense because we can't really change what interest rates are. That's a market thing that is going to dictate that. But once we identify the trends, we can act accordingly and protect ourselves because for every bad thing to invest in, there's a good thing to invest in that we could actually do. You know, and I'm not just talking about investing, I'm talking about things of life as well. There's certain things that we need to do to protect ourselves with the stuff that's coming because the policies that the government will create and come up with to try to counteract some of these things that are happening you could actually prosper from, or you could go along with them and they could destroy you. So these are the kind of things that we're going to be talking about. So the China devalued the yuan. Why did they do that? Well, if you've seen over the last 8 weeks that the Shanghai Stock Exchange is down 30%. 30%. And this is from the grass is greener on the other side economy, the manufacturing superpower of the world. Hey, let's invest in China because they're doing everything. They've got massive mountains of gold over there. They're going to be the world's next reserve currency. Let's invest in China, blah, blah, blah. We've heard all the stories. Well, what happened is they have too much debt. Their Shanghai Stock Exchange was so leveraged, and people were investing in it in margin that ultimately when it fell big time. It fell 30% in 6 weeks. I mean, this is just ridiculous. But we have to put that into context. The Dow Jones Industrial Average has about 500 million in leveraged debt. Well, billion. We're talking about 3% of all of the Dow Jones Industrial Average is done via margin. How much of the Shanghai Stock Exchange is traded via margin or leveraged? You know, people trading 10 to 1, 20 to 1. At 20 to 1, a 5% move means that you've doubled your money, but a 5% downfall means that you've basically lost everything on a 5% move. Well, they have margin trading of about 6.2% of the total valuation of the Shanghai Stock Exchange. Their debt is double what we have in America. See, they were ripe for failure. And so what that led to is, I don't know if you've all seen, but over the past months, there's been whiffs of rumors coming out of the IMF that they were going to vote in October to add China as another reserve currency, which would actually impact the dollar pretty significantly. They weren't going to take this reserve currency status away from the dollar. They were just going to add to it. Well, this is what China was hoping for. This is why they have mountains of gold over there, hoping that, hey, we can show that we've got some tangible backing behind what our currency, so therefore invest in the Chinese yuan. They were trying to make themselves look more attractive. But when you are consumed by debt, debt will always become the Achilles heel of the economy, and their numbers were fabricated. We just don't even know what to believe anymore coming out of there because the government cooks the books. We cook the books too here in America, but they really cook the books. And so what happened was the rest of the world lost confidence in it. That's why the Shanghai stock market went down 30%. Well, since then, the IMF has come out and said, we're reassessing our policy. We don't know if we're going to actually have China. We don't think China is actually ready to be a reserve currency. So what's next? I mean, this is what a lot of the big international globalists were thinking was going to happen, but this black swan event of the Chinese stock market going down 30% in 6 weeks put a kink into their plan. So now what comes next? Okay, let's just think about it. So you've got the U.S. dollar that's been the reserve currency of the world, meaning all international settlements are traded in that currency. That's what a reserve currency means. Whether it's the U.S. dollar, prior to the U.S. dollar, it was the British pound. Prior to the British pound, it was the Dutch currency. I mean, a reserve currency doesn't last forever. Why doesn't it last forever? Well, it's basically destined for failure from the get-go. The reason is, when all international settlements are traded in that currency, you've got built-in demand for that currency. A country will need to print more of it to basically accommodate all the extra demand. So let's just take the United States. We're printing, not just to fund our basically excessive lifestyle, not just to fund all the social programs and economic programs and everything that you know the consumer isn't paying for with taxes. The Fed is actually buying its own stuff that it prints. It's got this horrible balance sheet. When they're buying U.S. Treasuries with money that they print out of thin air, and the U.S. Treasuries are falling off the face of the planet, nobody wants them anymore, we've got a problem. The Fed's balance sheet is toxic. It's filled with toxic debt that nobody else wants. But they have to do that to fund the rest of the world that needs that reserve currency. So at some point, the rest of the world looks at this and it's like, oh my word, the United States is squandering its time in the sun. They're just printing without any discretion. They're destroying the value of their currency. It's now monopoly money, and they pick something else. See, this happened to Great Britain prior to us. This happened to the Dutch prior to Great Britain. See, it's time for the United States reserve currency status to actually be done. We have $18 trillion worth of debt that's mathematically impossible to pay back. We can't pay it back. So I think, it's just kind of in history, it's time to replace it. And I think they were planning on having maybe China be part of this mix. Well, now what? Now that they've said China's not ready, and I agree, China doesn't have the depth and breadth of a bond market to be able to accommodate reserve currency status. So it's really no shock to me that this is happening. So then what's next? What next, I think, would be just a global currency of some sort. Not another reserve currency tied to a country, but a global currency, probably a cyber currency, a digital currency of some kind, would be my guess. I think that's where we're going, but these are the kind of things that are happening right now, and the reason I bring it all up is because we have to follow this cycle through that a reserve currency never lasts forever. The U.S. dollar's time in the sun is in its twilight. It's just in its twilight. I don't know what follows next. Nobody does. I don't even think the IMF knows what follows it next, but they were thinking it was going to be China, but it's not. So why are we in the economic predicament that we're in right now? Well, there's signals that I like to look at. Well, let's just look at some. Government has become the price maker as the first. See, normally markets are very good at sending signals. Prices are signals. But in the current environment, with the advent of quantitative easing and all of these efforts by central banks to push the markets in a particular direction, basically an upward direction, we have a world where actually price signals might not really tell us very much about reality because government has become the price maker. See, Adam Smith, basically who was the founding father of capitalism, he had a concept called the invisible hand that said the markets will dictate prices and things will go up and down based on general market forces. But his concept of the invisible hand goes out the door when the government becomes the price maker. See, this also dovetails with Austrian economic type cycles that talk about interventionism that creates uncertainty in the markets and eventually a boom and bust cycle. Well, just today on Zero Hedge, it's talking about this exact thing that we're talking about. It's talking about the crisis that's coming. It's talking about how the dollar will cease to be a reserve currency if the Iran deal is rejected. That's what John Kerry warned. What do you mean? Are you threatening that the dollar will cease to be the reserve currency of the world if the Iran deal is rejected? Well, why? I mean, but what they're doing is they're just trying to condition us for what comes next. So what is the second signal that I look at? Well, that's the fact that debt can't be paid off. Our debt, it simply just can't be paid off. Dr. Pippa Malmgren, who was on Bush's plunge protection team after the Lehman Brothers collapse in 2008, 2009, she's brilliant. Well, she was interviewed by my very good friend David McElvaney on his weekly podcast, the McElvaney Weekly Commentary, and she said that debt can't be paid off. And if it can't, then taxes become a moot point. And that really makes sense because if you could have a tax rate of 100%, if it's impossible to pay off the debt, then who cares? If it's impossible, it's impossible. So then policymakers know this. The government people know this. So how do you deal with it then? How do you deal with debt that can't be paid off? Through austerity or inflation. This is exactly what's happening in Greece. This is exactly what happened in Cyprus. So this is a concern. And see, their concern is that if property prices start rising, for example, then rent goes up. If rent goes up in an emerging market, that creates enough pain that you can start to get social protests. If food prices go up, and we're having record high prices for proteins as an example right now, in Colorado, I go to this barbecue place for brisket. It's amazing. I love it. It's called Ceres Texas Barbecue. All their prices went up like 50 cents for every sandwich except beef. The beef went up $1. It's like, oh my word, beef basically is going through the roof. Well, it's because of the cost of transportation. It's because of the cost of grain. It's because of the cost of feeding these things. I actually wrote about this happening about 2 years ago. Because of the drought in Texas, the ranchers had to slaughter off tons of cattle because they couldn't afford to feed them, because there was no water to basically grow the grain and grow the hay or whatever they would eat in their fields, and so they had to buy it. So they just had to kill them off. Well, they killed off so many, now there's a supply glut, and beef is going through the roof. See, there's also the record high prices for things like lamb and fish. And these are the core issues for emerging market workers. And so they're going to start to go to the streets when these costs begin rising. So that's why emerging markets see it not just as a default, but almost as an act of aggression. Because in their view, in the industrialized world, destabilizing the emerging markets for their own interests. And so this is what's happening in Greece. This is what's happening in Cyprus. When they have austerity measures and inflation, it's going to cause civil unrest and protests. But you know what? We've already got civil unrest and protests here in America. See, these are just signs of the times. People are being squeezed at the margin, even in the wealthiest country on the planet. Our middle class is being squeezed out. The poor are getting poorer, but yet the rich are getting richer. But when the poor become poor and the middle class is being squeezed out, we've got some serious problems. And we're starting to see this unrest, this testiness in places like Baltimore and places like Ferguson, in other places around the country. It's rearing its ugly head as race wars, but we're also seeing class warfare. It's almost this bizarro world where everything that's right is wrong and everything that's wrong is right, and you can't make sense of it all. Well, this is just kind of dovetailing what's happening in the financial markets, where the government has become the price maker. People can't make any kind of rational decisions because all the stock market is up because of quantitative easing and stimulus. Well, when that ends, because taxpayers aren't paying as much in taxes because they're being squeezed out, all of this cycle comes to an end. And I think that is going to happen this fall. That's what this phone call is about. So another thing that we have to look at is interest rate cycles. And when you keep rates low for too long, ultimately rates go considerably higher than you would ever wanted them to go. See, this study was done by a guy named Knut Wicksell. He was a Swedish economist that lived in the late 1800s. And you know what? Nobody has ever refuted that to date. See, and rates have been coming down since 1983, when back then, if you were to get a 30-year mortgage on a house, it was 15 to 20%. Today, we're sub 4. But you know what? Janet Yellen in March said, hey, we've got to start raising rates. But we just have to, and why would she say that? Why would she say we have to when lowering interest rates helps stimulate the economy because it helps people borrow at a lower cost? Well, the reason that she has to say that is because the direct foreign investment in U.S. assets is down 60%, 60% over the last 2 years. The rest of the world is leaving the U.S. dollar like it's got the plague. They just don't want it anymore. So how do you attract more of that foreign capital inflow? What are the tools that they have? Well, they can raise interest rates. If you raise interest rates to 15 or 20%, the rest of the world says, you know what, the U.S. dollar might be monopoly money, but at least there's a reward to the risk that we're taking. So this is why interest rates have to rise. This is why she has to do it. So I have to ask myself, when she says that we're going to wait until September to raise interest rates, September, that's what she said back in March, why would she say that? Well, she knows that if direct foreign investment is down, the only way to attract more foreign capital is to raise rates. But why September? Well, what she was really saying, and this is my paraphrase, is, hey, America, I'm not an idiot. I'm chairman of the Federal Reserve. I can't raise interest rates during the heavy real estate months of the summer because that'll kill the real estate market. I'm going to have to wait until the fall. That's what I think she meant to say when you read between the lines, because she has to. They have no choice but to raise interest rates because the U.S. consumer isn't footing the bill for our $18 trillion debt and our budget, federal budget every year that's about $1 trillion more than what we're bringing in. So you've got to raise rates to attract more foreign capital since it's down 60% over the last 2 years. So who gets hurt when this happens? Well, pensioners get run over. And see, in that situation, it's the pensioners. They just get absolutely run over. See, for example, if the Chinese and the Russians and the Indians in emerging markets are not going to be buying treasuries anymore, then they would sell off or the government would have to buy them up. But there is another way, which is the government can say to every pension fund, you should only do safe things with the money that you're managing because after all, you're responsible for grandma's retirement, so our definition of safe is only our government's debt. And suddenly, pension funds are holding a whole lot more government sovereign debt than they would naturally, just because they feel under a regulatory pressure to do so. See, Pippa Malmgren, in her interview with David McElveen, he said exactly this, and she talked about it in her book Signals, which is a great book. She called this regulatory suasion, or moral suasion. Or you could actually call it immoral suasion. It depends on how you look at it. But what is another term for that? Bail-ins. This is what they did in Greece. It's like, and in Cyprus, actually. It's like, hey, people, Cypriots of the nation, you have got to actually pay more, and we're going to charge a one-off tax for any money that you have in the bank because you're our citizens and you owe it. The government has run out of money. So that's exactly what they did. Well, that's theft. But what was the key problem in Cyprus? Too much expenditures because they had way too big of an entitlement system. So too much money was going out, too little was coming in. The government ran out of money. So therefore, they figured they had to tax. But there's a problem with that kind of austerity. It means people are going to have even less money because austerity just means cutting government spending and raising taxes. So people are going to have less money to spend. That's going to have be detrimental to the economy. People are going to get hurt hard. And so the austerity measures that the European Union is putting on Cyprus and on Greece is ridiculous. And it's going to destroy their economies. See, this is why I think Greece ultimately leaves. But this is a catch-22. Because the European Union has been plagued by war for centuries. So this is why they started the European Union, because all these countries are fighting over political boundaries and whatever else. Well, how do you get political boundaries and political problems and race differences? How do you get those to kind of to dissipate some? Well, you tie them together economically. And that's what they tried to do in the European Union. Well, that only works for so long when countries basically give up their sovereignty for an economic union. And then you've got the rich countries like Germany as they're bringing in places like Bulgaria and Cyprus and Greece and these poor countries and these periphery countries. See, they're going to get sick of it. The German taxpayers are going to get sick of bailing out all these periphery countries. So they're going to actually ultimately stop because they've already dumped $300 billion into Greece of the $350 billion that they owe. So if Greece defaults and files for bankruptcy and just leaves the European Union, Germany's out a bunch of money. They're out $300 billion, and they lose face because now there's other countries in line beyond Greece, like Italy and Bulgaria and Portugal and Spain, and bigger countries than Greece that are saying, hey, we just want to walk away from our debt. We don't want to pay it back either. We'll just go back to trading in drachma or whatever they trade in Greece, whatever their currency is. So this is the problem. They lose face, and their experiment of a European monetary union goes the way of the dodo bird, but they also lose a ton of money. But can they afford to just keep paying and bailing them out month after month after month after month? See, this is how this is an impossible situation, and it doesn't end well. I think ultimately Greece probably just leaves, and then we have the fallout, and other countries start leaving, and the European Union might disintegrate before our very eyes, which for the globalist world, this is kind of playing right into their hand. If the U.S. dollar loses its reserve currency status, is the big kid on the block, China's going down in flames. Their stock market's down 30%. They're not financially stable. Their economy is a house of cards. It's like a Potemkin village. And you've got the European Union, their poster child for a regionally traded currency and economy, goes the way of the dodo bird. What's left besides complete global control of the economy? That's where I think that we're headed. But you've got to get the big boys out of the way for this to happen, or else people are going to have another good alternative. Well, I think the alternatives are going away. So some of the things that have kind of got brushed under the rug and seemingly go unnoticed in this economy is Bill Gross, which is one of the foremost bond managers in the world. He used to be at PIMCO Funds. I think he's now at Janus or something like that. He changed companies. Yeah, he's now at Janus. Well, he's possibly the world's smartest bond trader, ran the world's largest bond fund. He said that we are now in a new neutral with the global economy. And what he means by that is a low growth environment where we have so much debt today that it's going to be very difficult to see very much economic growth or to even justify very much growth in assets as a result of that. So it's actually worse than that because we're at the end of the interest rate cycle. So lowest rates globally can only go up from here. And if we're in neutral with low rates, what are we going to be in when they go up? See, we're going to get into economic shrinkage on a global scale. We also have massive amounts of interest rate cuts. See, to have a rate cut here and there to stimulate growth is one thing. And that's just normal. But on a global basis, central banks all over the planet 569 times in the last 3 years, they've actually lowered rates. That's the equivalent of once every 3 trading days, a central bank is lowering interest rates. See, let's put it like this. Some of you are gardeners out there, so if you wanted to grow hothouse tomatoes, you know what you do. You increase the odds of success by giving more water, giving more nutrients, giving more sunshine, and you keep it in that hothouse so that tomatoes grow faster and faster. Well, that is what we have tried to do with these 569 rate cuts. Then we have nominal GDP growth. Here in the United States, we've had average growth rate per year since World War II of 6.6%. That's how much our GDP has grown on average since World War II. But the last 7 years, it's declined to 3.5%. And last year, it was disappointing. It was 2.4. This is in a time where globally interest rate cuts are at an all-time high. We've lowered interest rates 569 times in 3 years, and our growth rate is coming down. The growth rate should be booming with that kind of stimulus, with that kind of cheap money, but it's not. There's a mismatch. And see, this is where we can tell that there's this underlying problem under the rug, and we're about to see a debt crisis unfold before our very eyes. Another signal. We're looking at a long-term bond implosion. See, if you're looking at intermediate or long-term bonds, basically, you're on the verge of being crucified. If you have them, I would be very scared, actually. See, we're on the verge. That is a term that certainly has a near-term urgency to it, but the reality is nobody knows when interest rates are going to go up. It's just a matter of time. So if anybody is in bonds, you need to be in low duration, fixed terms type bonds. If you're going to be in fixed income at all. But I would say do not be in fixed income at all. Because as interest rates rise, the value of bonds comes down. See, bonds were fantastic over the last 30 years. Why? Because they were at an all-time high, 15 to 18% on a 30-year bond in 83. Well, now 30-something years later, and now we're at an all-time low. So as yields come down, the value of bonds goes up. As yields go up, the value of bonds comes down. So bonds have been fantastic for the last 3 decades. Seriously, fantastic investment. But moving forward, and this is what's going to separate the wheat from the chaff, this is what's going to actually help protect people, is making choices at the margin. Moving forward, bonds are going to get crushed because there is nowhere else for them to go except down, because interest rates are at historical lows. Globally, I'm not even just talking in the U.S., we're talking on a global scale, interest rates are at an all-time low. What else is at an all-time low? Cash positions. Billionaires all over the world are stretching cash allocations with as little as 20% to as much as 62% of their portfolio. See, this is a far cry from the strategies of the 80s to the early 2000s, where people tended to be closer to 100% allocated into stocks and equities. Well, a report that I read, back in February, and that this report hasn't changed as of today, the average cash balance of mutual funds across the board is 3.2%. They're 97% allocated into equities, which are close to an all-time high. I mean, the stock market is collapsing before our very eyes. Just 10 weeks ago, the stock market was at 18,400. Today it's at 17,400. We're down 1,000 points in 10 weeks. That's 5.2%. Average that out for a 12-month span, that's a 23% downturn. But I don't think we stay static on that trend line. I think that the stock market actually starts accelerating its decline come September, October. So central banks are obviously committed to their schemes. They're fully allocated into equities. They're printing money like there's no tomorrow. We are stretched. Equities are stretched, and mutual fund managers are fully allocated. That means when stocks start to come down, mutual fund managers have no money to buy on the dips. They are just going to go down with the ship. There's a financial Armageddon coming. So central bank balance sheet. This one's ridiculous. This is another trend or a signal. The Fed balance sheets have grown to $22.5 trillion. This is the U.S. Federal Reserve. $22.5 trillion. That's more than the entire U.S. national debt. And what is their balance sheet made of? Money that they print out of thin air, that they buy U.S. treasuries and other things with that are toxic, that the rest of the world is starting to get away from. $22.5 trillion is greater than the combined economies of the United States and Japan total. This is ridiculous. Their balance sheet is out of control. But if it weren't for them buying our U.S. treasuries, nobody would be. The rest of the world, they've stopped buying it. The decline is 60% in 2 years, so they have to. There's $4.1 trillion in global debt that has a negative yield. A negative yield. In other words, you pay to own it versus being paid. You thought the way interest rates worked, you give somebody a loan to say, so they say, and then they return your principal with interest. Well, in this case, you're paying for the privilege to loan money, which is a little bit odd, but that's the state of affairs. 52% of all government bonds globally yield less than 1%. This is crazy. And rules are corrupt in our country. I mean, we're seeing that, which actually leads me to more spiritual signs. So those are the financial signals that we're looking at. Well, let's couple those with some of the spiritual signals that I'm looking at. We live in a culture of lawlessness. See, I really believe that this is a physical manifestation of a spiritual battle. I think that it's a spirit that really is being fostered from the White House itself. See, it's a spirit characterized by blatant disregard for authority, disrespect for people, property, and others' beliefs. And I believe this lawlessness is being masked under a banner of racism and class warfare. Seriously. But this signal has cultural revolution written all over it. It's very similar to the 1960s. See, I think we've entered into a culture of lawlessness. Just look at our Justice Department. The Justice Department doesn't even adhere to the law anymore. They don't penalize criminals. They penalize law-abiding citizens. This is a culture of lawlessness. I'm just kind of reporting what I see. See, there's anti-American sentiment. See, over the years, overreach of the United States, sometimes legitimately getting involved in matters of state overseas, or even due to illegitimate exercises that I can't really call anything but maybe an imperialist temptation. We are hated around the world. Americans are hated around the world. I mean, that's a broad brush stroke there. I mean, not everybody hates us, but this sentiment is becoming more and more scary as the days go on. But anti-American sentiment is also growing and festering in our own country. It is. See, thirdly, a spiritual signal is we're living in a post-Christian era. You know, morality has gone the way of the dodo bird. It's almost like a bizarro world where I talked about before, everything that's wrong is right, and everything that's right is wrong. See, Christians are being attacked for their beliefs, yet other faiths are being encouraged to practice their religious beliefs without repercussion. This is evidence that we've slipped into a post-Christian America. And these are just cycles. These are just cycles that we're looking at. We're also looking at the end of U.S. dominance. How can I tell? Just follow the money. See, this, I believe, I used to think it was the century of Asian dominance, but it might be the century of global dominance. You know, money is flowing out of America. There's no doubt. It's flowing out of Europe. There's no doubt. Pretty much it has been going to Asia, but they've also squandered it too. It may be a little bit too early to tell, but China's economy is a house of cards. It's a shell game that was built on excessive debt. But so maybe this isn't the time for Asia, but maybe rather something more sinister and even more severe. And I don't want to sound too conspiratorial here, but this is playing right into the globalist hands. The world's reserve currency, the dollar, is about to bite the dust. The poster child for regionally traded currency, the euro, is about to go belly up. China has greater unsustainable debt and leverage than America ever did. So where will we go from here? Well, maybe I'm just speculating, maybe a Pan-Asian currency offered by the AIIB, the Asian, Interchange Bank, or maybe just go for the throat and cut out all arbitrage opportunities and competition altogether and go for a global currency of some sort. See, our reserve currencies and regionally traded currency cartels are falling apart. Debt will do this every single time. We get what we ask for pretty much, whether we like it or not. Well, lastly, on the spiritual cycles, we're entering into a Shmitah year, which this is the perfect culmination of all the financial cycles I've talked about, culminating with a spiritual cycle. So if you haven't heard about it, I'll just take a few minutes here to explain it, because I'd be remiss if I didn't bring up this as one of the cycles, because things are playing right into the timeline that's basically orchestrated in the Torah since creation. See, the wacky thing is that September 13th of this year, of 2015, is the 29th of Elul on the Hebrew calendar. See, that's a remission, or a purging of debt, or a release. That's what that means. But after 7 Shmitah cycles of 7 years, which is 49 years, so every 50th year comes a Jubilee year where all debt is wiped out. The land is laid to rest. See, starting September 13th of 2015 and going to September 28th of 2016 is a Jubilee year. In the physical, we're talking about how 2016 could be a debt implosion. In the spiritual, this is a year of Jubilee where all debt is wiped out. Is this coincidence? Well, you see, I think that all cycles are a bunch of coincidences put together, which means they're really not coincidences at all when you look at them, historically. It appears it may be. See, 50 years prior to this next Jubilee year was 1967, the Six-Day War. And Jordan was forced to give up territory back to Israel. See, somebody had to give up something, and it was given back to God's people. 50 years prior to that was 1917. That was the Balfour Declaration, gave the Jewish people a national home in Palestine, which was again given back to the Jewish people. So what about this time? What happens this time? Who knows? In an age of anti-Americanism and anti-Semitism globally, any kind of giving back to Israel as a result of a spiritual cycle will wreak havoc in the Middle East and probably embroil the rest of the world. So the Shmitah year, let's go back to it, September 13th of this year. Well, what happened 7 years ago? 7 years ago was 2008. In September, we had, what did we have? Lehman Brothers collapse. Oddly enough, that happened on the 29th day of Elul, which was the last day of that Hebrew calendar cycle, the Shemitah year. That's when that happened. The largest stock market collapse in the history of America came on Elul 29 on the Hebrew calendar. Let's go back 7 years before that. What happened then? Well, we had 9/11. September 11th, the World Trade Center was decimated. The stock market closed down for exactly 7 days, 1 week. It reopened up when? Oddly enough, on the 29th day of Elul, had the largest stock market collapse in history until the Lehman Brothers collapse, and now we're coming into another 7-year Shemitah cycle. So, does this mean that God has to work in this exact same cycle this time? No. God is God and God is sovereign, and He doesn't have to. He can do whatever He wants. However, history doesn't appear to be on our side here. And the crazy thing is it's coinciding with these financial cycles. See, I want to go over a couple other financial cycles which are astounding. Astounding. So there's a cycles kind of analyst, I would call him, Peter Elliott. He studies 33-year cycles from market bottom to market top. And so he goes all the way back to 1857. There was a low. 32 years, 7 months later, it topped in May of 1890. Well, then it hit a bottom again in 1896. 33 years and 1 month from then was a market high in September of 1929. Then in 1932, you hit a market low, and the crash 33 years and 7 months hit an absolute market high on the stock market in February of 1966. Then that stayed there for about 16 years, and that brings us to a series of 3 bottoms. October 1966 brings us 33 years. That brought us to a high in January of 2000. 1974, 32 years and 10 months after that, brings us to an October high of 2007. Then you had the Lehman Brothers collapse. October 1982 was a low. 32 years and 7 months after that was March of 2015. Oh my word. To March of 2016 with an average. See, they have an average there. 32 years and 7 months, 32 years, 7 months is a short. 33 years, 7 months is the long of Elliott cycles. So what's the long? September of 2015. Boy, he's picking tops. He picked the top in 2015, in 2007, in 2000, in 1966, 1929, 1890. This 33-year cycle picks market tops. He's got a market top coming in September of 2015. So let's look at another one, because I don't want to look at just one cycle. There's a guy. Let's see. His name is Bo Polney. Amazing. He follows a 21-year cycle. And he goes all the way back 252 years to the Currency Act of 1764. So let's go back there and look at a 21-year cycle. So then you had 1785 as 21 years. That was a monetary panic in Holland. That created a depression. Then 1806 to 1807 was another depression, 21 years later. 1827 to 1828, depression number 3. 1848, there was a recession. 1869, a recession. 1890, a recession. 1911, a major panic in the markets, and that's been written about numerous times, the panic of 1911. Then 21 years from there is the Great Depression, 1932. Then you go 21 years from there, 1953 and 54, we had a recession. Then that takes us to 1974, the stock market crash of 74. 1995, an inflationary rise, and that brings us to 2016, a year of Jubilee. So even 21-year cycles are ending up in this year of Jubilee time frame. This is crazy. 33-year cycles, 21-year cycles, the Shmitah year cycle. You've got Janet Yellen saying that we're going to raise interest rates come September. Well, boy, when America is in debt up to its eyeballs and the rest of the world is in debt up to its eyeballs, even raising rates from 2 to 4% isn't a 2% increase. That's a doubling of the rate. People who have any debt are going to be crushed. Well, who has debt? Consumers have debt. Municipalities have debt. State governments have debt. The federal government has debt. We're in debt up to our eyeballs. So what else is coming? September 15th, we've got some other potential triggers. It's the 70th session of the UN General Assembly. It begins on that date. And it's being reported now that France plans to introduce a resolution that would give formal UN Security Council recognition to a Palestinian state. So up until now, the United States has always been one blocking such a resolution, but Barack Obama is indicating that things may be much different this time around. September 25th to September 27th. See, all of these signals are happening around the Shmitah year cycle. The United Nations is going to launch a brand new sustainable development agenda for the entire planet. Some have called this basically Agenda 21 on steroids. A lot of you are familiar with Agenda 21, environmental controls and so forth. But this is Agenda 21 on steroids. It's not just about the environment. It also includes provisions regarding economics, agriculture, education, and gender equality. See, on September 25th, the Pope will travel to New York to give a major speech kicking off the UN conference where this new agenda will be unveiled. Yet another spiritual cycle, September 28th, is the date of the last of the 4 blood moons that falls on biblical festival dates from 2014 to 2015. See, we're entering into some major, major catastrophic times coming up this fall. September and October could be horrendous. We've talked about economic cycles. We've talked about financial cycles. We've talked about spiritual cycles. Well, what can you do to protect yourself? I mean, oh my word. Well, we're coming off a year of, or actually 3 years of consolidation in the precious metals markets. See, wise investing tells you to buy low and sell high. See, with all of this stuff happening, gold and silver should be going through the roof. But it hasn't been. It's been held in check, basically, for the last 3 years. But this is just a 2 steps forward, 1 step back. 2 steps forward, 1 step back. So what we're looking at is after 21 months. Actually, let's look at some of these cycles of 21 that Bo Polney actually looked at and actually apply it towards gold and silver, okay? We've looked at it compared to the stock market, which is predicting a fall. But gold hit a top in 1980 at 873. Exactly 21 years later, a cycle low at 255 arrived in 2001, and a new bull market began. Then 7 years after 2001, a cycle high arrived at 1,033 in 2008. Then 3.5 years after that, half of a 7-year cycle, gold topped in 2011 at 1,900. Then in May of 2011, silver topped at $49. Then 21 months later, silver and gold collapsed, with gold falling from 1675 to 1179. Silver fell from 32 to 18. So after another 21 months, a bottom arrived in November of 2014 with a cycle bottom of 1130 for gold, and then 21 trading days later, silver dropped to 14. See, we're looking at some serious number 21 cycles. And I'm not a technical trader, but cycles tend to repeat themselves. So are these by coincidence? No, probably not a coincidence, but they're probably occurring by design. So what these numbers tell us is that 2015, 2016 should see gold and silver just absolutely go through the ceiling. That's what these numbers are telling us. So, you know, I generally don't go into technicals because I don't care. I'm not a technical trader. But in the long-term pattern of cycles, which repeat themselves over and over and over and over again, and we have a 250-year history, these things are repeating themselves, and the timing is uncanny. When you talk about what Janet Yellen is saying, what's happening in China, what's happening with ISIS, when we've got this debt implosion, all coupled with a Shmitah year and some of these other things, boy, people, I would just say, if you've got bonds, run from them like the plague. If you've got equities, get out of them because the stock market is incredibly overvalued. You need to reallocate into gold and silver. You just simply just do, because you can buy that at a low. Everything else is at a high. Gold and silver are at a low point, and we can gobble up these trends. You can allocate retirement assets in an IRA into precious metals. It's easy to do. We can help you with that. I've been helping people for the last 14 years. I've got 1,800 clients all over the world. And see, our firm, we have stocks. We can do bonds. We can do precious metals. I'm pretty much bias-free on what we offer because we offer everything. But oh my word, just because we can doesn't mean that we do. I want to make sure that my clients are in the right place at the right time, that we take advantage of these trends so the trends don't take advantage of us. Give us a call. Reach out to Jim and Cindy, who put this call together. They can get in touch with me. But you can go to my website, KirkElliottPhD.com. Call my office number, 866-211-8986. That's my direct line, and talk to myself or any of my assistants. Or email me. K Elliott, that's KELLIOTT @McIlvaney.com. That's MCALVANY.com. So K Elliott @McIlvaney.com, 866-211-8986. Give me a holler, or reach out to Jim and Cindy that are putting this conference call together, and they can get in touch with me. They know how to find me. But boy, the window of opportunity is coming up. We are starting to see the dominoes fall before our very eyes. The market action over the last 10 weeks on the stock market, the Dow is down over 1,000. Interest rates can only go up from here. We've got China's stock market collapsing 30% over the last 8 weeks. Things are unraveling. Debt is taking control. That's the Achilles heel of the global economy. And our reserve currency status is at risk, and there is no other alternative other than a global currency. I mean, this does have global control and domination, cultural revolution written all over the events that I'm talking about. But there is a way to protect yourself. Financially, you grow with the positive trending asset classes, pure and simple, and it just happens to be gold and silver. In the 80s and 90s, it was stocks and bonds and real estate. So this is all I'm saying is follow the trends. Don't try to pretend, that we can control these markets. Just follow the trends. They'll lead you in the right direction, and that's all I'm saying. We'd love to help you out. We don't have a bias in any direction. We're used to these kind of things. We think like you do. We prepare for things ourselves. We homeschool our kids. Oh my word! We're in for a world of hurt, sadly, as the global economy goes. Cyprus and Greece are just the tip of the iceberg. That's just what happens when governments run out of money. We're no different. America is no different. America has run out of money. So why would we expect any kind of a different outcome? So protect yourself. It's weird to think that food and fresh water and other things that are hard assets, tangible assets, commodities like that, are investments. But if we enter a stage of hyperinflation, I mean, I just read one of the emails that was sent out for this call that said, are we going to repeat the 1929 all over again? No, we're not. We're not going to repeat 1929. That was a deflationary depression because you actually had some tangible backing behind the currency back then. There was some kind of discretion to the spending. As the business cycle slowed down and people were losing their jobs, prices came down. The mechanics are different this time. The economy is slowing down. People are losing their jobs. But the mechanics that the Fed has, the only thing that they have left are austerity and inflation, because taxes are irrelevant at this point. So austerity and inflation, that means prices are going to go up while people are losing their jobs. That's an inflationary depression. That's multiple times worse than a deflationary depression. This is what they had in Weimar Republic Germany during the Weimar Republic hyperinflation, when mommies and daddies couldn't afford to feed their babies and they got paid in wheelbarrows full of cash twice a day because prices were doubling every other day. That's the kind of environment that we're entering into because of the policy of the Fed to print without discretion. That creates inflation. And when you've got people that aren't working because the business cycle is slowing down, when you couple that with higher prices and higher taxation, that's a recipe for disaster. And those are the signals that I'm looking at. I wish it weren't the case. I wish there were a better outcome, but we can't change these trends. We can't change these cycles. All we can really do is identify them, protect and preserve, and act accordingly. And really, you can thrive. I mean, I'm going to end with this. Back in 1913, gold and cash were convertible. A $20 bill was equal to 1 ounce of gold. You could go to the store and trade them back and forth. So let's just say you had $1 million back then. You had person A and person B. Person A kept all of his $1 million in gold. What is it worth today, 102 years later? $1 million back then is worth $62 million today. If the guy who had $1 million in cash, in U.S. dollars, what is that worth today? Sadly, it's not even worth $1 million. It's worth $20,000. See, this is where inflation is a hidden tax. So this is where view gold and silver as an insurance policy against a collapsing currency. That's at its core what it is. So $1 million turns into $62 million in metals. $1 million in cash turns into $20,000. Oh my word! They used to be equal. This is the difference of having something that doesn't have tangible backing versus something that does. That we're talking about legacy here. We're talking about creating a legacy for future generations and passing on wealth from generation to generation. When you allocate properly into gold and silver, when asset prices come down hand over fist in this collapsing economy, your portfolio is going to grow and you can buy those depreciated assets for pennies on the dollar. This is how we created so many millionaires during the Great Depression. See, you're not going to probably hold gold and silver for the rest of your life. It is a tool. It's simply that. It's a tool to protect and preserve everything you've worked your entire life to accumulate. At some point, we're going to want to spend it. We're going to want to use it. We're going to want to trade it for an undervalued asset class after it grows. So from a PhD economist perspective, that's my view of the world as I see it right now. As investments go, there's very few options to invest in other than tangible assets. You could probably find some private equity or something, invest in specific companies, but not on the stock market. And those are few and far between. They're very hard to find. But hey, do what you can do. Allocate wisely. Gold and silver, have cash on hand in case we have a banking failure, banking crisis. And by all means, get out of equities, get out of bonds. They're toxic right now. So anyways, hey, Jim, I'd like to open it up for some questions, and we can just kind of go from there.
All right. I've got a whole ream full of questions here that people have put in. The first one is, and somebody else caught this. This listener writes in and said, you said there was a glut of beef when ranchers were slaughtering cattle because of lack of feed, and the prices went up. That doesn't make any sense. Flooding the market would make prices go down. What gives? Can you re-explain?
Yeah, I'm sorry. I didn't explain that properly. Prices went down when they were slaughtering all the beef. They went down a ton, and that's why about a year ago, beef was at an all-time low, and they were slaughtering. But now there's a supply issue because there is no more beef. They slaughtered them, so prices are through the ceiling. So it's the delayed effect of slaughtering everything in the last drought season that we have such huge prices now.
Yeah, and I know that's what you meant to say. It just, I caught it, and another listener caught it. Your tongue got in the way of your eye teeth, and you couldn't see what you were saying.
I know. So. Talking too fast.
I know. Another listener's written in and said, what is your opinion about having a 401k in this market? Good, bad, or get out?
Well, it's a great question. If I have a 401k, I minimize my contribution to it because I get a match. So I get $1,000 match. So for every $1,000, I get $1,000. That's it, though. Then it caps out. So all I do in my 401k is put in $1,000 because I get a match on it. That's free money. I don't contribute any more. But here's the pickle. Some people just can't get out. But if you can and you're willing to take a penalty, a 10% penalty, pay your taxes, there's many good opportunities that you can invest in outside of that, like gold and silver, which you don't have that option inside of a 401k. So you're going to have taxes at some point anyways. I'd probably take the hit now at probably the lowest taxes that we're going to see in our lifetime, and allocate into something that is going to grow. Granted, it's not going to be tax deferred like a 401k is. There is pros and cons to this scenario. But when equities are going down, so you have to get out of stocks in your 401k and you just sit in cash, well, when inflation's hovering unofficially at 9% and you're only getting less than 1% on your cash, you're really losing 8% a year. So you keep that 401k in cash for 10 years, you've lost 80% of the value of your portfolio. Makes no sense. I'd rather have you take a little bit of a hit now on a penalty and potential tax and go into something that's poised for growth, even though you lose tax deferral.
Yeah, and I think I've had this conversation with before. For all the folks that are listening, they really probably need to take it on a case by. You've just spoken to the whole audience, but really, if individuals have 401ks, they probably need to have a one-on-one with you so that you can get all the particulars of each individual and help them make an informed decision rather than just making a blanket statement and saying, what everybody needs to get out of their 401k, because that may or may not be the case. Is that a true statement?
That's absolutely true. I mean, it depends on your tax status. It depends on the hit. It depends on your age. It depends on all kinds of factors. But given everything that we've talked about, broad brush, all else being equal, it kind of makes sense to get out. But in real life, not all else is always equal. So in anything that we're saying on this call, what Jim said is incredibly important. We can't use a cookie-cutter approach for everything. We talk about it on a case-by-case basis. That's why I would love to talk to you and go over you specifically so we can optimize your goals and your safety and couple that with everything else that you already have. Because I don't know what your investments are right now. Maybe you're 100% allocated into gold and silver already, and you need to have a diversified portfolio somewhat, so you have to have some cash in your portfolio. So, I mean, these are the kind of things that we actually go over if we're talking one-on-one.
And that's absolutely true. There's nothing that displaces that intimate knowledge of each individual and working one-on-one with you. So I just wanted to stress that. We've had we've got some astute people on the call tonight. How does a metal IRA and a depository get handled if the government takes a 20% tax off the top of all IRAs, as we saw in Cyprus and with austerity?
It's going to be taxed like all other IRAs or 401ks. I mean, it's going to be a retirement account like any other retirement account. So you would be subject to that one-off tax. But here's the thing. when you're allocated into gold and silver in an IRA, it is being held in a depository. It is being held in storage. There's numerous companies that try to do LLCs where you can hold it at home or whatever. I just was meeting with experts in the field. It's just the IRS doesn't view it that way. I don't care what companies say. The IRS doesn't view it that way, and I would rather err on safety. So when you're allocated into tangible assets, physical gold and silver coins in an IRA, what's coming, it takes an act of Congress. We're going to look like Cyprus and Greece before they would actually do a bail-in. So we're going to have time to jump off the tracks before they would confiscate anything. So here's what I would say. Put it in there for now, because that way you can roll over your IRA assets into gold and silver, hold it in storage. When it comes time where it looks like there is going to be a bail-in in our country, we get in touch with you, because we're seeing this like a freight train coming down a hill, and we're going to say, hey, look, whatever the consequences are, take a like-kind distribution. Don't liquidate your metals and take cash. We can actually ship you the metals in your IRA. You take distribution out of your IRA in like kind. That way you're getting what you have invested. You just change the way that you own it. That's how I would look at it. It's a great way to do it.
Yeah, and I think you just touched on another listener's here is, what do you think about taking possession of precious metals through a self-directed Roth IRA? And I think when you were last time in Florida, you spoke over in Orlando, and Cindy and I were there, and I think you touched on a couple of examples that you had recently seen where the IRS had gone in and dealt with a couple of individuals rather severely that had done this.
Well, the question there is on a Roth IRA, which is different than what you're referring to, Jim, but I'll address both. On a Roth IRA, you don't pay any taxes upon distribution. So it makes sense.
Yep.
So, but the more growth that you can get, see, once you take it out, basically your cost basis is reset, and you'll have to pay capital gains on it at some point down the road whenever you sell it. So the longer you can keep it in a Roth IRA, the better, because as it grows, you don't have to pay any taxes on that growth. So what we're doing here is we're balancing, is there going to be a bail-in? When would it be? Keep it in there as long as you possibly can. I don't think we're going to have a bail-in tomorrow. I don't think we're going to have a bail-in next month. But I think the time is coming. But it only takes us a day to lock in a trade, submit the request for IRA assets to be sent to you, and then about a week later they're sent. So we're talking about a 1-week lead time. That's really not very long. So we can get stuff done before the freight train mows us over. But the other question is people setting up an LLC that actually they can. So an IRA owns this LLC. The LLC can have whatever kind of assets they want. You store semi-numismatic coins, whatever you want, at home. I mean, in the tax code itself, it talks about how they have to be stored by basically a government-approved fiduciary. People are not. The LLC is not. So this is why this loses in tax court. You know, they'll point to different little regulations and stuff, but they make no sense. So if you actually read really closely, it makes no sense, the points that they're pointing out. I don't want my clients. Our goal here is to get you out of harm's way, not make you audit bait and get you into harm's way. I mean, I had a client who didn't believe me on this, tried to do exactly that, got audited, and had to pay a $200,000 tax hit. It's like, because the government didn't view it as an IRA. They viewed it as a distribution many years ago, and then he had to pay the penalties and all this extra tax, and it's like $200,000 hit. He thought he was smart and had this attorney that said, nope, it can be done. You know, I'll vouch for you. Well, they'll vouch for you as much as you want, but they're going to come after your assets, not the attorney's assets in court. And it's just sad. So I would say do it the safe way. Do it the legitimate way. When it comes time to really get out of harm's way, we'll just take a distribution out of a legitimate IRA and you take physical possession of it.
Listeners written in and said, I own a Canadian and a U.S. company and have considered moving all my assets into Canada and even relocating. How will the Canadian economy be impacted by the devaluation of the U.S. dollar?
Pretty severely, because they're connected at the hip, pretty much. A lot of Canada's economy has to do with energy, and energy is falling off the face of the planet, down 55% this year. Canada already has proposed legislation for bail-ins. It's like we don't even have that yet. So Canada isn't necessarily as safe as what you would think it would be. I mean, the only benefit to having assets in Canada is that it's taxed differently, in your IRAs and so forth. But if you have Canadian stocks or whatever, but I don't like the equity market right now. Anyways, it's way too overvalued. Revenues are declining. It's ripe for a collapse.
Another question a listener's written in. A group in Hong Kong has created a financial platform called the iAccount that lets you open an account in one of 10 currencies and move the balance between currencies as you prefer. They also issue a MasterCard called the iCard that can be used worldwide. What is your opinion of using a vehicle like this for the average investor to be able to protect their wealth by holding their balance in a foreign currency?
Well, other currencies aren't really doing any better than the U.S. dollar. I mean, look at the U.S. dollar has lost 98% of its value to gold over the last 100 years. It's just lost 98% of its value. The Japanese yen has lost 97% of its value against the dollar. So if the dollar's lost 98% and the yen has lost 97% against the dollar that's lost 98%, oh my word, that currency is in shambles. Fact of the matter is there isn't a single currency on the planet that's backed by gold. They're all fiat-based currencies. Everyone thought China's currency was going to be strong because they had sort of mountains of gold that they were hoarding. But we're seeing their economy go up in flames, so much so that the IMF doesn't even want to utilize it anymore. So I would kind of put that sort of a strategy into the likes of Bitcoin. Now, cyber currencies are pretty cool. I get it. You know, it's a way to sort of hedge yourself away from a sovereign currency that may be imploding. But when push comes to shove, it's a digital currency. All that it takes is for the internet to be shut down and all your wealth can't be accessed. Same thing with those iCards. It's just a debit card. So if there were an EMP blast or something, you know, any kind of digital currency I don't view as safe as stuff that you can have on you to barter with. That's true wealth in my opinion. It might be a good way, for if you have a day trading mentality to trade back and forth pretty quickly. Just that's the way I would view like a gold and silver ETF as well. It's great for day traders because it's electronic. You can just bop in and out and in and out and in and out. That's not me. I've never known a day trader that actually hasn't lost their shirt. You know, just by the same consequence, I've never known somebody who's buy and held for the long term forever that hasn't lost their shirt either. Nothing goes up forever. Nothing goes down forever. You have to be a student of the markets and student of these cycles, and you can gain some of these intermediate gains and losses. But at this stage of the game, I would say go into physicals as opposed to something digital. If you were to have asked me that 15 years ago, I'd say, oh my word, that is a fantastic idea. I love that idea. but we're not at that stage anymore in the global economy.
You know, and just before we went live on the air, you and I were talking about zero hedge. You even mentioned zero hedge in your talk. I'm looking at the screen right now, and as it relates to what you and I were talking about 5 or 10 minutes before we went live, there's an article up on Zero Hedge on the second page right now that says, this is not a drill. India, Russia, and Thailand prepare for currency war. At the moment, with the turmoil in the market, some currencies may look good, but when a major player starts monkeying with their currency, I didn't happen to look at the Forex markets today to see what happened with China, but look what happened 6 months ago when Switzerland or Sweden, I forget which country, had pegged their currency to the euro, and then all of a sudden they said they would never do that. And overnight, it sent the Forex markets into turmoil, and there were many traders who were completely wiped out. In fact, there were several major Forex players who were left with a margin call in the hundreds of millions of dollars. I think one margin call was like $520 million. Whenever you start messing with exchange rates and currencies and stuff, that's a game that I'm not prepared to play. How about you, Kirk?
No, I'm not prepared to play it, and neither are nations, actually either. Jim Rickards wrote a great book called Currency Wars that talks just about this, and this is how it works. So the U.S. dollar is losing money hand over fist. 60% decline in demand over the last 2 years. So how do you increase demand? Well, you raise rates. So this is a globally integrated economy. So now we raise rates, we start pulling in a little bit more foreign capital inflow. Well, then Europe says, wait a second, the money we used to be getting is now going to America because they raised their rates. We're going to have to raise ours too to match it, and then we'll beat it just a little bit. Well, then Japan says, wait a second, the money that we used to be getting is now going to Europe and America because they raised their rates. We're going to have to raise our rates more. And then it comes full circle, and the United States has to do the same thing over and over again. That's a currency war. These currencies start battling for the global capital inflows, and you could see rates into the teens in a matter of 6 months to a year.
We've run way over on time here. I've got time for one more question, and it relates to real estate, something that Cindy and I really like. What do you predict with regards to the real estate market this fall?
Well, I love real estate too. I mean, I'm a real estate kind of a guy, but it's a fundamental reality of real estate is going to be a function of interest rates and the jobs. If people don't have jobs, they can't afford to buy stuff. As interest rates start going up because the United States has to raise their rates to attract more foreign capital, the affordability of buying real estate goes down. So I think real estate gets hit pretty hard. It probably gets a 30 to 40% decline would be my guess. I'm just guessing. Might be less, might be worse. But now, if you're kind of sitting on the sidelines a little bit and you have cash or you have gold and silver that's appreciated in value, you know what? Buy real estate 2 years from now or a year from now after everything kind of falls apart. You can use an inflated asset to buy real estate for cheap. And if you buy it right, you can produce a ton of income. I mean, I have a buddy who he lives in Houston. He's buying mobile homes for like $10,000 to $20,000. He calls them his little mini mansions. So he buys them for cash. He makes a very good living, and he buys them for cash, and he buys probably 6 to 8 a year, maybe more. So, and he can rent them out for $500 a month. So at that, he's basically breaking even in about 14 to 15 months. After that, everything's pure cash flow. Well, he's now probably got 30 of these things that he's paid cash for. See, low-income real estate is going to be great as the economy collapses because people are always going to need a place to live. People aren't going to want expensive stuff. They're going to not want middle-class stuff. They're going to want low-price stuff. And so that's the only real estate part that I like. But don't go into debt to do it. I would really only do it if you can do cash for it. And where we live, we don't have, I love that idea. I love that strategy. We don't have mobile homes that cheap where we live, or else I would be doing that. And I can't, be a landlord in numerous states away. So, I got to say, real estate is okay if you buy it right, but I think that the price is going to come down substantially over the next couple of years.
You touched on this earlier in your talk when you were talking about Weimar. After the Weimar collapse had occurred, and people with gold and silver were able to go in and buy up whole city blocks in Berlin, and that's Hitler. A lot of the people that did that were the nationalists that funded Hitler and brought him to power. It's kind of interesting, but that gold, those gold coins, you could go in and buy up huge tracts of real estate in a collapsed economy. So I think what you just said is spot on in my way of thinking. And one more thing, that you talked about that $20 gold piece back at the turn of the century. And one of the things that I've found out is that $20 gold piece at the turn of the century, say in 1895 or so, would buy you a custom tailored suit. And that same $20 gold piece today will still buy you a reasonably custom tailored suit in a haberdashery in most cities in America today. So it's withstood that inflation or the deflation of the currency or the fiat currency. So it's pretty amazing when you look at it in that regards.
Mm-hmm. Absolutely, absolutely. It's what can your assets buy you? You know, view everything in terms of gold. You know, how much does it cost to buy something in gold? And over time, it will maintain your purchasing power. Always has, always will. This is why I said gold and silver should be an insurance policy at its base. We just have the luxury of it, you know, going from $250 to $1,200 an ounce-ish over the past 12 years. It's been a fantastic growth opportunity as well to protect and preserve and thrive. See, don't go away from this phone call with your head in the sand and scared and thinking, oh my word, the world is falling apart. There's nothing I can do. Absolutely untrue. The world is falling apart. Yes, that part is true. But there are things that we can do to protect ourselves and thrive and create a legacy that will go on for generations when we think outside the box and make hard decisions that 95% of America isn't going to make. This is what is going to separate you from the rest of America, and this is the kind of stuff that does create millionaires. I mean, there's as gloomy as this call sort of was, there's a lot of hope in this call if you act. It's not just enough to hear, Jim. You have to act on what you hear, and that's where there's the hope is. Absolutely. Well, listen, we've run way over on time. Could you give us your contact info again so that our listeners can get with you to map out a strategy that works for them? Yes, sir. Phone number is 866-211-8986. My email is KELLIOTT, just my first initial and last name, K. Elliott, at McIlvaney.com. That's MCALVANY. Or else you can go to my website, which is KirkElliottPhD.com. I had another website, America's Financial Doctor. It got hacked pretty bad. Google made me shut it down, so it's being rebuilt. I hate when that happens. Yeah, it's in the process of being rebuilt right now. That's good. Kirk, it's been great having you on the webinar tonight. We are pretty much out of time, and I wanted to tell you how grateful we are that you've been a friend and supporter of Life Changes Be Ready. And there's not been anybody with your education and expertise who's specifically reached out to the preparedness community and that understands the self-reliant lifestyle and mindset. So I just wanted to thank you that you've taken an interest in us personally, and you've taken an interest in our viewers to give them an opportunity or give them options on insulating their wealth and their hard-earned assets, so that they can withstand the storms that are looming on the horizon. I really appreciate that, and just wanted to thank you. Well, it's my pleasure, Jim, and you and Cindy do an amazing work with what you do on Summer of Survival and helping people get prepared. And that's what it's all about. We don't want anybody to go down with the ship. You know, together we're stronger than we are individually. And you have an amazing, I would call it a ministry. I really would. You do an amazing work, and you're helping a lot of people. And always, I will be on here whenever you want me to. It's just that important to me. So just let me know. It's been my pleasure, and thank you for all that you do. We really appreciate it. And, you know, when it comes to finances, there's a lot of charlatans out there, and I know that our listeners, in fact, we have a gentleman here in town, I think, that recently contacted you and was able to do some stuff with you. It's
it's important to develop a level of trust. And I know that Cindy and I have been around you and gotten to know you, and so we're confident that after tonight's presentation, we want our listeners to know that they can reach out and get to know you and develop that level of trust, so that they can move forward with the advice and the material that you offer. So I just wanted to encourage our listeners to reach out, because time's growing short, and those storm clouds are ever present on the horizon. And so if you're listening, I just want to make sure that you guys understand that Kirk's just a phone call away, and that if a lot of you contact him all at once tomorrow, he's going to be swamped. And when we got on right before the call, he was saying that he had a really, really tough day today. Really not tough, but busy, because of all the gyrations in the market and people moving to insulate themselves. And so don't wait, folks. It's time to move forward. It's time to and whether it's with Kirk or somebody else, I'm just telling you, it's time to take your savings and your hard-earned funds and find the plan that gives you the greatest level of protection and comfort. And I know that Kirk has helped quite a few people that we've sent his way, and so now's the time. And Kirk, we thank you again for a great evening.
Thank you so much. It's my pleasure. Y'all have a great night.
Thanks. Folks, mark your calendars. Our next webinar will be Thursday, August the 20th. The details will be out in the coming emails. And we did take the summer off. We had some kids graduating from college, and my youngest went off to college, and so we were running here, we were traveling, and so we did take a couple of months off just to make sure we could devote all our attention to that, because it does take a lot of effort to put all this together. And but our next webinar will be Thursday, August 20th at 8 p.m. Eastern Daylight Time. Mark your calendars and watch your emails for the details. I want to thank you all for joining us tonight. We did have a large number of listeners on tonight. I was encouraged that you all responded to the email and joined us tonight. And so I just wanted to thank you. I am your host, Jim Thompson, and from all of us here at Life Changes Be Ready, remember, life changes, be ready. And as things ramp up, it's going to happen pretty quickly. So make sure that you guys keep your eye on the horizon, because storm clouds are out there. Good night and God bless everybody.